All right, I'm here with Todd Rosenbluth, Director of Research here at VettaFi. Todd, been a big year in ETFs, not a ton of flows, but a lot of activity. What's innovative and interesting to you right now?
So what we have seen a lot of is actively managed ETFs. They are roughly a third, 25 to 30, 35% of the flows that we've seen through the first 4+ months of the year. We've seen Capital Group, we've seen American Century with the Avantis brand, Dimensional Funds, JP Morgan in particular.
Plus all the fixed income guys who were already here, right? Fidelity was already there, PIMCO was already there. We had a raft of those. Are they generating real new assets, or is most of this coming from conversions?
So the money that's coming in this year is net new money. There haven't been any conversions. In fact, Dimensional Funds that converted funds en masse a couple of years ago has actually seen net inflows, close to $10 billion for Capital Group. JP Morgan is, of course, the heavyweight in that space. They've got the two largest of the actively managed ETFs. JEPI passed JPST, the active fixed income ultra short ETFs. That was, I guess, a key milestone, is that we're now back to equity ETFs, at least on the number one spot of the products, gaining traction. So we've seen growth there. We've seen growth actually in defined outcome or the buffered ETFs from Innovator in particular, but we've seen it with First Trust and Allianz, to name a couple of other firms that have had it. They've seen some nice traction this year. The volatility in the equity marketplace makes those products all the more compelling. As you know, you protect the downside for investors, but participate in some of the upside. So that's where we've seen some of the growth. And then April, and now starting into May, we've started to see some of the traditional beta-oriented products see inflows, investors wanting to capture some of that strength that they've seen. So the Vanguard 500 ETF, VU, iShares Core S&P 500 started to gain traction. The NASDAQ QQQM,
That's where all the action's been, right? I
Yes.
mean, all the money's been out of the large queues and into the small queues, largely because of price, one assumes, right?
Cost still matters to many investors, and especially if it's the same product. I know, I'm a big believer that what's inside an ETF matters, but when what's inside is the same
literally
thing,
the same
why
thing.
not just pay less money to have it? And so that's why VU was gaining share over SPY. QQQM is gaining share with over the triple Qs. A couple of those examples.
One thing we haven't seen a lot of, it seems, has been a lot of smart beta product, a lot of factor-based product. Now, some of those funds have done pretty well. We had a window where Minvol was really outperforming. We recently celebrated the anniversary of RSP being on the scene, sort of the first of the smart betas, if you will, the dumbest of the smart betas, right? Just equal weight the S&P 500. Do you think that advisors have lost their appetite for those quant solutions and are instead looking to active managers for much of what they would have gotten out of some sort of multi-factor product?
So yes and no. So we are seeing money go into active management that might have gone into smart beta when that was the only game in town to get exposure to active-like strategies at a competitively cost situation. The active ETFs we talked about earlier, Dimensional Funds has products that cost around 20, 25 basis points overall. Same thing with JP Morgan. The Capital Group ETF that's leading the charge there, Dividend Value ETF, I think is 33 basis points. So this is really cheap for active management. Whereas you can get index-based products for 15 basis points, the smart beta ones that are there. What's been popular this year has been quality.
Yeah, anything that looks
ETFs.
like quality, dividends, anything throwing off revenue, anything that's like a proxy for viable company status. Yet at the same time, it's been a lot of the large cap tech that's really rocketed the market on those days when it comes back. I mean, it's very much a bifurcated market with a handful of winners and a whole lot of losers. Do you feel like there's a shift that advisors may be having around, like, look, we got to get back to our knitting. We're not going to go after all these crazy new ideas the industry comes up with? I certainly hear that from advisors that, like, they're simplifying their portfolios.
They are. I think they are. And what we're seeing, I thought where you were going was so much money. So the market's being led by a handful of stocks. So what do? So you can do one of two things. You can believe the rally isn't going to be there, and that means most stocks are down for the year, that maybe you want to pare back or you want to reduce the risk profile. SPLV has been actually very popular. That's the Invesco S&P 500 low volatility ETF. It started to see inflows it saw inflows in April. We've seen some multi-factor oriented products, OMFL, again, I'm naming Invesco products that are top of mind, but we're also seeing that investors are interested, starting to look more interested in value-oriented ETFs. It's something that we're writing more from a research perspective. I've been working on it earlier today. As to, do you believe the pendulum is going to swing back again towards value if those growth stocks have run so far so fast as of late? Does a value-oriented approach, or at least even an actively managed value-oriented approach, make sense in this environment?
Interesting you bring up OMFL. Back when that was an Oppenheimer product back in the day, that was one of the first outperforming multi-factor funds we had. It had about a 2-year window where it was beating all comers in the multi-factor space. Then the whole space seemed to die out, and now it seems to be coming back. It must just be the bifurcation in the markets, right? When you create that much divergence in returns, sometimes those factor strategies are going to work.
Yeah, and that product in particular, as you probably know, can rotate. So it's five factors, but it can rotate where the exposure is. As to some other multi-factor ETFs, it owns quality and value and size, and it only owns those. The stocks inside rotate, but not necessarily the factors.